Hey everyone, welcome back to my channel. If you're new here, I'm Sam, your go-to for all things finance. Today we're diving into an important topic, credit scores. So you can have a sharp understanding of why having a good credit score is essential, how it's calculated, and most importantly, how you can improve it. Plus, we'll touch on how your credit score impacts your ability to get a mortgage or loan, how often you should check it, and much more. So, what is a credit score? And why is it important? A credit score is a numerical representation of your creditworthiness. It's used by lenders to decide whether to approve your loan or credit card applications and what interest rates to offer you. A higher score can save you thousands of pounds in interest over the life of a loan. It can also impact your ability to rent a flat, get a mobile phone contract, or even land a job. If you are wondering why employers check credit scores, let's say you're applying to the finance director position. Then the employer might view your credit score to understand the financial responsibility. If personally you are not managing your pocket, how are you going to manage company accounts? Also, your finance history indicates your trustworthiness. From employer point of view, they have to mitigate the risk. So the credit history needs to be clear and well maintained if you're thinking about a decision-making level career. How is your credit score calculated? In the UK, credit scores are primarily calculated by three major credit reference agencies: Experian, Equifax, and TransUnion. They use information from your credit report, which includes your payment history, credit utilization, length of credit history, types of credit in use, and any new credit accounts. Each agency has its own scoring model, but they generally follows these components. Also, these are the factors that can affect your credit score. Payment history, 35%. In history, lenders evaluate your ability to pay your bills. You must pay your bills on time. It's worth setting direct debit payments for recurring bills like electricity, gas, and tax. Credit utilization, 30%. The amount of credit you're using relative to your credit limit. Let's say you have £5,000 limited credit card. If you use £3,000 from it, because you have that limit, you are using 60% of available credit, which means you're a high-risk customer, so your score will be reduced. Always try to keep it below 30%. Length of credit history, 15%. How long your credit accounts have been open. The longer the period, better. Types of credit, 10%. The mix of credit accounts you have. I will take a little time to explain this. Having a mix of credit types, for example, credit cards, mortgages, and auto loans, can positively impact your credit score. Lenders like to see that you can manage different types of credit responsibly. New credit, 10%. Recent credit inquiries and new accounts opened. How can you check your credit score? You can check your credit score through the three major credit reference agencies. They offer free and paid services to access your credit report and score. Nowadays, most banks update individual scores on the app. Maybe you have that facility in your bank app. Regularly checking your credit score helps you stay on top of your financial health. How often should you check your credit score? It's a good idea to check your credit score at least once a year to ensure there are no errors or fraudulent activities. However, monitoring it more frequently, such as quarterly, can help you stay proactive about your financial health. What steps can you take to improve your credit score? Improving your credit score takes time, but it's definitely doable. Here are some actionable tips. 1. Pay your bills on time. Payment history is the most significant factor in your credit score. 2. Reduce your credit card balances. Keep your credit utilization ratio below 30%. 3. Avoid applying for new credit frequently. Each application results in a hard inquiry, which can lower your score. 4. Check your credit report regularly. Ensure there are no errors and dispute any inaccuracies you find. How does your credit score affect your ability to get a mortgage or loan? A higher credit score increases your chances of being approved for a mortgage or loan and securing a lower interest rate. Lenders view you as less risky, which can save you a significant amount of money over the loan term. Does checking your credit score frequently affect it negatively? No. Checking your own credit score is considered a soft inquiry and does not impact your score. It's only hard inquiries, which occur when lenders check your credit for a loan or credit application, that can affect your score. How long does negative information stay on your credit report? In the UK, negative information such as late payments, defaults, and bankruptcies can stay on your credit report for 6 years. However, its impact on your score will diminish over time, especially if you maintain a positive credit history afterward. Can you get a credit score if you have never had credit before? It's challenging to have a credit score without any credit history. To build your credit score, consider starting with a credit builder credit card or a small loan. Ensure you make timely payments to establish a positive credit history. Having a good credit score is crucial for financial health. By understanding how it's calculated and taking steps to improve it, you can secure better financial opportunities. Remember to check your credit report regularly and address any issues promptly. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more finance tips. Thanks for watching, and see you in the next video.